This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks for having me as always. Appreciate you.
Awesome. So folks don't know, you've been added to the channel the last 6 months or so. People love our discussions. We often disagree, which everybody loves. You are a 10-year Wall Street veteran. You play in a world that I can only dream of playing in. So take anything I'm about to say with a grain of salt. But how the hell can the stock market go up or perform well with all the shit going on today? Rates, strong dollar, earnings coming in, multiples collapsing, fear, the VIX. You got freaking British pound doing this, and the yen and currency interventions, and the 10-year note at 383. I don't get it. I don't understand. I mean, why would anybody?
After all that, I take back my argument. I take back my argument. I'm on your side.
You're on my side. I give up. I quit.
Yeah.
Oh,
no,
man,
you're right. There are so many cross currents going on right now. So many kind of firsts in the world, and first, all of these things have happened. Been happening simultaneously. This and that. For context, prior to my comment, and Michael can attest to this, that we have been since the beginning of the year saying we don't like stocks.
Yes,
like we're investors, so we do buy stocks. Our portfolios that we run, which I'm not talking about here, but involves a plethora of stocks, bonds, commodities. We have been saying we have light stock exposure. It's not saying we're not investing in stocks, because we are, but our stock exposure has been on the most conservative side it could be based on the portfolios we build.
Yeah, you have rules that you must follow. Yeah,
correct. The entirety of the year, we have said we don't like stocks. Outright overt. We don't like stocks. We said it earlier on in the year. We said stay away from growth. Growth does not do well in a rising rate environment. We said stay away from crypto, which was a not necessarily a well-taken thing, because everyone said crypto is an inflationary hedge. That's gone. Crypto is a tech stock with a higher volatility, a 3 to 4 time higher volatility profile.
Up and down.
And then, up and down. Exactly right. And then obviously we saw, the market melt down to June. Mid-June, it hit a bottom. And then it kind of chopped along sideways. And then July, August, it ripped. It got back half of what it lost. And we said during that time frame, earning expectations are coming down. This does not make any sense. August 17th, we said stocks are going to go down. They're down 14% since then. But
real quick, where are these posts that people can go back and look? Where do you put them?
Oh, so today you'll get one specifically that just highlights some of those things I just said, just to say, like, guys, we said this. We're not making things up. We're not saying that we said that and we didn't say it. So yeah, follow us at Life Goal Investments on Instagram. We put out stuff daily, and we're very candid about what our thoughts are. And that's, I don't think, all that common.
It is not common, and that's why you're on this channel every week, because you'll say it as is, own it if you're wrong, but also take a victory lap when you're right, man. Celebrate a little bit.
Yeah, well, that's, I guess, what I'm doing here. But no, so our opinion's changing a little bit. So we do feel that there's been, like, all of those things you said are all pessimistic things, and it's hard to find optimism out there.
Did you see the put call ratio?
Yeah, well, that's been bad for a while. That's been bad. It flipped.
I don't remember it at 1. Yeah. Crazy.
Yeah. So, but I guess, but the point of this is the market has a tendency to start to feel a bottoming out process when things feel absolutely worst. And that's kind of potentially where we're at. And I don't think that we've seen the bottom. I do think there's more downside to be had here, but like with our portfolios and kind of how we build them is we kind of build in 4 slugs of risk within the portfolios and the construct of how we can have them deployed. Right now, we have 0 out of the 4 deployed. And what we're going to start to do now is start to take out a quarter of our conservative assets and start to dollar cost average into stuff that's a little bit higher risk. And when I say a little bit higher risk, I don't think that NASDAQ growth stocks are going to do well. This is not an environment for NASDAQ growth stocks. And people say they're off the most. They deserve to be off the most. But dividend producing kind of growers, value type stocks that have done well this year, we think will continue to do well. And what we'll do is we'll chunk in 4 kind of pieces of it, and we're just going to bite it off. So put a little in relatively soon. I'm not saying it's happening right now. We do think there's more downside, but chew a little bit off. And then if it goes down, chew more off. And that's kind of the approach you got to take here, because calling a bottom, no one does it.
Aaron. Yeah.
Fool's errand. It's a fool's game to try to call the bottom. So we're not trying to do that. But I guess my point is we think that almost all the pessimism is built in the market. Your put call ratio, meaning more people are thinking things are going to go down than go up, is a contra indicator over the long term. Pessimism is rampant right now. Optimism is non-existent.
You have, what's the VIX? Have you checked out the VIX right now? Can you do that real quick?
The VIX is, yeah, I'll grab it right now. The VIX is one where we haven't seen as big of a spike, actually. The VIX is the volatility index. So generally, as things get scarier, the VIX ticks up, right? And it's at 31 right now. Between 30 and 40 is kind of, I heard someone call it the F bucket, and F standing for the word that you think it is. That's where it is a tough environment to navigate. Anything over 40, it's like, get out of the way. But between 20 and 30 is like, that's still high. Sub 20 is where things start to be normal again.
Okay. Yeah. Because I do think you're right. I think negativity is growing. The very interesting thing is, again, you're a Wall Street guy. So it feels like Wall Street got out of the way 2 weeks ago, 3 weeks ago. Main Street, retail, whatever you want to call them, they're still buying the dip. I don't get it.
Yeah. And I think, and some of that's not bad, right? So you look at it from a long-term perspective, and this year has not been a year to buy the dip. And we've been vehement about that on our channel as well. Like, don't buy the dip. But if you're just looking at it from a really long-term perspective, people have to start to separate two buckets of money. Your age dictates your retirement money. Your time horizon and when you need that money dictates what you should be doing with assets outside of a retirement bucket. So people need to start to think about, okay, buy the dip. Yes, you continue to buy the dip in the 401k because that's going to perpetuate you over the long term. Higher risk is probably going to pay out well over a 30-year period. But when you're looking at stuff that's inside of 5 years, 10 years, you need that to be more conservative, because if you have to sell right now, it's not a good feeling to sell high risk assets that are off 40% right now. But if you have a low risk asset or a conservative diversified portfolio that's down 10%, you can stomach it. But people just dictate what they buy by their age. Oh, I'm young, high growth, high tech stuff, long-term risk, I'm good. What happens when you have to sell it down 20, down 40%, which has been this year? It's a really tough thing to have to stomach.
Yeah, I don't mind, if you will, dollar cost averaging, or, hey, I put $500 in the market every week regardless. I think that's wonderful. But what does leverage look like? Is leverage being wrung out, or margin, whatever you want to call it, or is it being run up? My fear is retail is actually starting. What retail investors, again, I say this as somebody who was this investor 20 years ago. I get down, I push more chips in, which means leverage, because it has to be near a bottom, because I can't be down. I'm better than this. So what is going on with margin debt? Is it up or down, or do you not know maybe?
So I think people buying on margins, and I'm admittedly giving you this from one brokerage firm that I pay a lot of attention to, is actually coming down. The use of leverage is coming down.
Oh, good. Well, that's actually good.
Right. So people aren't necessarily perpetuating themselves and doubling down, et cetera. They are just taking risk off the table in general, is kind of what we're seeing. What you see over the long term, and JP Morgan publishes this stat every single quarter, is that over the long term, the S&P averages over the last 20 years, 9.5%. So that's what stocks have done, 9.5% over the last 20 years. The average investor has done 3.8%. So it's like, guys, we got to stop talking about what the S&P does over time, because people don't sit their butt in the seat through the tough times. And you may say, okay, that's because they have bond exposure. Bonds have returned almost 5% over the past 20 years. So again, 9.5, 5, 3, 9. Like, they're barely outpacing inflation. It's really, and obviously in this current environment, obviously not outpacing inflation, but long-term inflation's at 2%. That's the risk, is that people get too much risk on their balance sheet and they get shaken out at the wrong time, because things feel good at the end of 2021. Nothing could go wrong at the end of last year.
Yeah.
The economy was humming. Everything looked great. That's the time when people feel really comfortable investing. It's the time you shouldn't feel comfortable investing, and you should feel more comfortable in times like this. But that's not how the mental psyche works. Brains are hardwired for survival. This goes back to Darwinian times. Like, it's fight or flight. And the only thing you have the ability to do, you can't fight the market. It doesn't. How do you do that? You fly. And that's how people sell out at the wrong time.
Yeah. The last thing kind of on this topic, as I look at this, it's still numerically correct that if you look at discretionary index or you look at the technology index, there's 2 companies in each that make up roughly 40% of the index, right? Discretionary, I believe it's Tesla and Amazon, and the technology, I believe it's Microsoft and Apple. I don't know that any of this is going to happen, but I look at those 4 companies and I go, shit, if one of those has a earnings pre-announcement because of currency, because Chinese consumers aren't buying, because that could be the thing that takes VIX from 30 to 40. It could be this or that. Those 4 companies have an outsized domination.
Apple's right now bouncing against 150. That's an important number for Apple. There's support at 150. If it goes through that, that could be a tough run on Apple, just from a stock price perspective, not from they're rolling out the iPhone 14 and the demand, any of that, which is affected by a consumer that's weakening, et cetera. But just from a technical standpoint, when you look at the stock, it's bumping against 150. It's at 150.63 right now. But that is that point of support. And to your point, and just for clarity and context for those that are listening, the S&P 500, each one of the companies in the S&P 500 doesn't get an equal share of how important they are, right? The larger companies disproportionately affect the S&P 500, and Apple is obviously right at the top of the heap within the top 3, and they're bouncing against 150 right now, and they have been a stalwart juggernaut, ability to hold up during anything this year. If it gets through that, it could be a little bit more downside, and that could cause real pain for the overall market because they are so important.
Yeah, and this is kind of where I wanted to go, because I think there's 2 things that I see going on. First, and you can do it any order you want. First, Stanley Druckenmiller talking about a lost decade. And then second, it feels like we are entering a stock pickers market and not an indices market. Again, I'm not the stock guy, don't own any stocks. But it just feels like we're heading to those. So feel free to take either topic in either order.
Yeah, I think it's a good headline grabber by Stanley Druckenmiller. I think that it's tough to look throughout history and see too many periods where you would have batted well betting on a lost decade, right? The market does go up over time at 7% real after you take out inflation. So it's tough to say that you're going to have a market that looks like it returns negative over a 10-year period. But full disclosure, at the beginning of this year, if you look at Vanguard, BlackRock, the big asset managers, they were projecting not real, nominal returns by U.S. stocks at about 3.5%. That's what Vanguard said, 3.5% return over the next 10-year period of time. So it doesn't take that crazy of an outsized effect to get 3.5 down to closer to that no return type number. But over a 10-year period, I think that although we just took it on the chin this year so far, obviously, that it does battle back. So I do think that that's probably a little bit overstated. If you were to make the argument that potentially real returns, because inflation's so high,
real and nominal,
could get you real being after you have the return of the S&P 500, you take off what inflation was, and that's your actual purchasing power. You might be able to get to negative there. Again, 3.5% if Vanguard is right. When you average out what inflation is over the 10-year period of time, you might get down to darn near zero there. So I think that it's 100% correct that it is a stock picker's market. And I don't necessarily advocate for an individual trying to pick stocks. I think it's probably a losing battle there. But I do think that you can start to pick managers or sectors potentially that have historically held up better through tough times. Like, we are huge proponents of dividends right now. So dividends have averaged over the last 100 years of the S&P, 40% of the return of the S&P 500 have come from dividends. And when you look at it, and I'm going to butcher this a little bit, so take it with a grain of salt, something like in lower than average returning decades, it's something like 60% of the return comes from the S&P 500 comes from dividends. And that makes sense, right? Because if they still kick off a 3% dividend, if they only make a lower return, it becomes a higher percentage. But that just goes to show you that dividends are something that if the company can continue to spin them off are very important. And when you think about, okay, is this company going to continue to be able to spin off that dividend? You can look at things like dividend payout ratio. So a dividend payout ratio, you're kind of in the weeds a little bit here, but dividend payout ratio is just saying, okay, how much cash do they have hitting their bottom line? And of that cash, how much are they paying out? So sometimes you'll see things leak above 90%. And all of a sudden, if a dividend payout ratio gets above 90%, it's not good. Because what happens is if they have to cut their dividend, the market hates that. And rightfully so, because it says you're not earning enough and something's going on with your business that might be wrong. And the market chops the knees out from under companies that have to cut dividends. And it happens. But that is what you have to look out for. That dividend payout ratio is the best way to say, is this dividend going to be able to continue? And I guess I go around and kind of down a rabbit hole at this point, but like dividends are something that are more reliable in the market that is going to be choppy, which we continue to think this one will be.
Yeah. I guess to kind of wrap up on this dividend topic, do you have a favorite dividend ETF? Because I'm sure some people would like to look that up. Is there one that you like, or you don't want to?
Can I plug my own?
Of course. If you, I'm assuming you like yours.
Yeah. So our Wealth Builder is our highest dividend oriented product. It yields above 4% right now. And what you get within Wealth Builder, so again, it's the Life Goal Wealth Builder, the ticker on it's WLTH, like wealth without the vowels in the middle. But what you get in that portfolio is what we feel you should be invested in. And what that means is you get a blend of stocks, bonds, commodities, and real estate. Right now, the stock exposure is at about 55% of the portfolio because we're negative, right? We're saying that we don't love stocks right now. But as I mentioned earlier, we're going to start to redeploy some of that low risk asset back into the stock bucket as we get more comfortable with things chopping along here down at very low rates that we see right now.
I like it. I like it. How do you get exposure to real estate in that ETF?
REITs. Yep.
There you go.
REITs, and we're specific as to what type of REITs we have because REITs are not a game.
They're all not all equal.
They're not all equal, and holy smokes, has that become evident this year because some REITs have absolutely taken on the chin. And over time, what you see with REITs is that they are less interest rate sensitive because they have the ability to bleed through the increasing price on rents. But in the short term, you don't reset rents every month. And therefore, in the short term, it does take a hit on REITs.
Absolutely. Well, Taylor, it's been a lot of fun. I appreciate your time. Thank you so much for being a part of this every week. Where can people find you?
Yeah. Thanks for allowing us a little plug here. At Life Goal Investments on Instagram is where we're putting up stuff on a daily basis.
Awesome. Thanks, buddy.